Netflix just reported earnings. The stock dropped about 4%. But the real question is Netflix still a buy after earnings? In this video, we'll break down Netflix's earnings report, what the company actually reported, how the market reacted, and whether Netflix still makes sense as an investment right now. First, let's quickly look at Netflix's history. Netflix started in the late 1990s as a DVD by mail business, disrupting traditional video rental companies by letting customers rent movies without visiting a store. Over time, Netflix successfully evolved from physical DVDs into a global streaming service. The company shifted its focus to online subscriptions, invested heavily in original content, and expanded internationally. Today, Netflix is one of the largest streaming platforms in the world, competing with major media and technology companies. So why did the stock drop after earnings, even though Netflix beat expectations? The short answer is, expectations were already very high, and the market focused more on forward-looking factors rather than past performance. Let's start with Netflix's most recent quarter, Q4 2025. Revenue came in at about $12 billion, up nearly 18% year-over-year, showing strong top-line growth at Netflix's current scale. Operating income was just under $3 billion, with operating margins around 24%. While margins dipped slightly compared to earlier quarters, Netflix remains highly profitable and continues to generate strong earnings. Net income was approximately $2.4 billion, and diluted earnings per share came in at about 56 cents. Free cash flow was nearly $1.9 billion, showing that Netflix continues to convert revenue into real cash. Now let's look at the forecast. For Q1 2026, Netflix expects revenue of about $12.2 billion, representing over 15% year-over-year growth. Operating income is forecast to rise to nearly $4 billion, with operating margins expanding to just over 32%. Net income is expected to increase to more than $3.2 billion, and earnings per share are projected to rise to around 76 cents. Netflix also continues to reduce its share count, which supports earnings per share growth and benefits long-term shareholders. Beyond the headline numbers, the earnings report revealed several important strategic developments. One of the biggest positives was advertising. Netflix made it clear that its ad-supported tier is scaling faster than expected. Advertising revenue more than doubled in 2025, and management expects it to roughly double again in 2026, making ads a meaningful second growth engine alongside subscriptions. Another key point was engagement quality. Netflix acknowledged that total viewing hours grew modestly, but viewing of Netflix originals increased strongly. Management emphasized that not all engagement is equal, and that high-quality, fan-driven content leads to better retention, lower churn, and stronger pricing power. Customer satisfaction and retention both reached all-time highs. Netflix also highlighted expansion beyond traditional streaming. The company is pushing deeper into live events, live sports, video podcasts, and cloud-based gaming. While these initiatives are still small today, management sees them as high upside opportunities that can increase engagement and monetization over time without changing the core business model. Competition was another important theme in the earnings call. Netflix does not view competition narrowly as just other streaming platforms. Management sees competition across all forms of entertainment, including traditional television, YouTube, social media platforms, gaming, and live events. What's important is that Netflix continues to gain share of attention in this crowded landscape. Even after years of growth, Netflix still accounts for less than 10% of total TV viewing time in major markets. This suggests that the company is not close to saturation and still has meaningful room to expand engagement and monetization. Management also emphasized that the competitive environment is becoming more blurred, with many companies combining streaming, live sports, linear TV, and social content. Rather than viewing this as a threat, Netflix sees it as an opportunity to win more viewing time by offering a broad, flexible entertainment experience powered by global scale, strong content, and improving technology. Despite intense competition, Netflix highlighted that retention remains among the best in the industry, and customer satisfaction is at all-time highs. These factors support Netflix's pricing power and long-term growth, even in a highly competitive market. Now to the Warner Bros. Deal, which played a major role in the stock's reaction. Netflix confirmed it is moving forward with an all-cash acquisition of Warner Bros., including HBO and HBO Max. This raised short-term concerns around debt, integration risk, and the temporary pause in share buybacks. However, management positioned the deal as a strategic accelerator. Warner Bros. Adds a massive content library, a global film and television studio, and the HBO brand, which is widely associated with premium television. Netflix believes this will enhance content depth, improve subscriber value, and strengthen its long-term competitive position. Netflix also pushed back on the idea that the acquisition signals weakness. Management stated clearly that organic growth remains strong and that Warner Bros. Simply accelerates a strategy that was already working. The majority of future revenue is still expected to come from Netflix's existing core business. Overall, the stock reaction appears to be driven by short-term uncertainty rather than deteriorating fundamentals. Investors reacted to elevated expectations and the size of the Warner Bros. Deal, while the underlying business continues to strengthen. To be clear, I do not currently own any Netflix stock. That said, if you are looking into Netflix as an investment, I personally think the stock still looks attractive. Revenue continues to grow at a healthy pace. Margins are expanding over time. Advertising is becoming a meaningful second growth engine, and free cash flow remains strong. While short-term volatility is likely, especially around large strategic moves like the Warner Bros. Acquisition, the long-term fundamentals of the business continue to improve. For long-term investors who can tolerate some uncertainty, Netflix appears well-positioned going forward. Thanks for watching, and I will see you in the next one.